welcome back to Market Call. We've got Keith Richards on the show. Time now for top picks, and these are very interesting. The first one is Ford. For a guy who likes price action to the upside, you're picking one that got smacked around.
Yeah. Well, I mean, so this is in our aggressive platform, so I have to point this out. So some of my trades are like conservative, a longer term or whatever, but this is not. We're trading this. So swing trading is like something I just like doing. And it's you know, there's a pretty clear pattern. This is going back to 2022, that the stock really doesn't like to go much below $10, right? So if you can buy somewhere near $10, then, you know, and play it up to any one of these points, you're making some money. So what if it only goes back to, you know, I'll try to draw the lines here, but that's probably like $13, that's probably 14, you know, et cetera, maybe even as high as 15. Like, we bought it at around, I think it was around 10.50, or I think it was around 10.50 because we bought it a few weeks ago.
So when it got down,
right off, it was just starting to bounce off. And we said, okay, let's take one leg. So remember, we work in legs. And by the way, we're probably going to buy another leg. I really like this trade for the aggressive account. So it's not for conservative investors. But
well, and I think we're looking at the long-term chart, and that's interesting because it basically dropped 30% in a very short period of time. But over the long term, I guess you can see that it stayed in its range.
Yeah. So you play the range. You don't get emotional. You just buy it. You sell it.
To 15? You'd play to 15?
Maybe even 13. I don't know. Like, I mean, if I buy it,
you got to tell me.
Yeah, I'll phone you.
What's the number? What's the number? So 13, maybe 15.
Yeah, 13 to 15 bucks.
Okay. You said earlier in the show that you're bullish on commodities in general. One way you're playing that is the ZMT, which is the BMO equal weight global base metal ETF. What do you like?
Well, again, this is one of our longer term plays. We have owned this for a while, and you know, it's been pretty good. We you know, went up, and it's been consolidating, and we think it'll do that for a while, and it'll break out again. I mean, that's just, you know, a pattern that you often see. But I mentioned before, there's a cycle where financial assets take a backseat to hard assets. Doesn't mean financial assets go down. It just means that hard assets have their moment of glory, and financial assets have had their moment of glory. So we think that there's going to be some rotation into commodities over the coming years.
This is hedged to the Canadian dollar. Yeah. Was that on purpose?
Not really. I mean, well, to a point, there's always taking the risk out of the dollar, but in case because commodities trade in U.S. dollars. Yeah. But we were more just because we like the mix, and it's a good TSX traded base metal thing that we can own for a while.
Okay, so I find that interesting because your third kind of commodity exposure is the Van Eck Oil Services ETF. I guess because there's no oil services. Is there an oil services ETF in Canada?
Yeah, so there isn't.
No. So because you want the services play.
Precision Drilling is a Canadian company.
Is a company for sure. Yeah. So, but you want the services play OIH on the NYSE ARCA. So what is the play? Why do you want to play energy through the services?
Well, again, we think it's overlooked. Like, if you look at some of the oil stocks lately, I mean, here in Canada, take a look at Suncor. It's just, you know, it's broken out. It looks good. Not all of them have, but, you know, then the oil services have been largely ignored.
These are like the Schlumberger, the Baker Hughes, the Halliburtons. That's what's in this ETF.
I mean, they got to service the people that are yanking it out of the ground, right? So, and refining it. So, you know, there's a bit of a base going on that we see, and you know, we don't mind if you're picking up near the bottom, and eventually that base will break out, and hopefully, especially to follow the oil, if you believe the oil stocks are going to go up, then this has been a little bit of a laggard, so maybe this is a value play. So we've got a bit of this.
And would you do? Is this your preferred way to play energy, or are you looking? You mentioned Suncor breaking out. Are you looking kind of broadly at this sector?
We own Suncor, by the way, too.
Okay, good.
But
bonus top
So
picks.
yeah. So we have some oil producers, and we have just this one service stock. It's only a 2% position, by the way, but. So we like the whole gambit, and it is a little bit of a longer term.
It's a longer term, whereas Ford is a swing.
Ford is a swing.
Okay, so we'll keep that in mind. And the base metal ones is?
Longer term.
Longer term? Yeah. Okay, so you do pick some long term.
Yeah, we do. It's just a lot of our stuff is in and out. Yeah.
Welcome back to Market Call. Now time for the cherry on top of the show, which is top picks. Earlier we spoke about Nike, which you did not like, and your first pick is Lululemon. So it's not about the space, it was particular to Nike. What do you like about Lululemon, which has also been beaten up?
Yeah, and so I mean this is a new position for us, and we like buying it after it gets beat up, and that's what we've been able to do in the last couple of months here. And so there's three issues affecting Lululemon. The first is their North American sales have slowed this year. So there's questions around, is that competition? Is it these new yoga companies like Alo Yoga taking market share? Is it a Lululemon product issue? But the North American business has slowed. The second issue, they had a product problems, and that was just announced about a month ago, where one of their new fabrics was not the most flattering when their customers actually purchase it. They're getting really bad feedback. That was going to be a big growth driver. Now that's at least off the shelves for 6 to 12 months, and maybe an inventory write-down. And then the third issue is, while you're growing your international business 35% year over year, but it's very focused on Chinese growth, and the market just doesn't want to touch anything China-related right now. But we look at Lululemon as a stock that used to trade at 30 times. It's now trading at 19 times. Very, very strong margin profile. You get margins higher than the group average. It's still going to grow, we think, much faster than its peers, and it trades in line with them. And this is a company that has a history of innovation. The belt bags from 2 years ago that everybody now has bought. So they're just one hit product away from, we think, seeing this re-rate back to 25 times and
you bought the dips in retail before. You bought Aritzia when it was thrown out, and it went on to recover. Let's move on so we squeeze in the others. Airbus, is this just a Boeing's loss? Is Airbus gain, or is there something else? Yeah,
pretty much. I mean, this is another opportunity to buy a company that's had a short-term issue. Airbus is trying to increase their production of their narrow-body airplanes to 75 a month. And the supply chain challenges are just not letting them get there. So there's a big guide down in their near-term production in May, June of this year, and that's what really drove the stock down. But they still have 10 years backlog. It's going to be trading at 16 times in a couple of years, so great opportunity.
You said you like REITs and interest rate plays, Northwest Healthcare REIT. Is that an exposure to rate cutting? Is it something else?
Yeah, so it's a little all of the above. It's there's a new management team in there. It was over-levered, too much debt, too much floating rate debt, and that hurt them on the way down, but now that's going to benefit them on the way up. So last year they cut the dividend. They've done about $1.6 billion of asset sales, and now as rates come down, their property values will stabilize, their interest costs will come down.
We're talking about a company that used to be $14 last year, so it has massively come down. What kind of re-rating do you think we'll see?
So their net asset value per share, which is the internal property value, if they sold the company, they estimate that to be around $9 a share. Most REITs are trading at a discount to that NAV number, but this is one of the largest we've seen. We think it has the most torque to the upside. And the most important part is their properties are all medical, hospital, office buildings, doctors' offices. Very stable. They have very long-term leases, and the properties are all performing very well. So it's just been a capital structure issue. That'll get fixed with lower rates.
20 seconds, but there's a 7% dividend yield. They've already cut the dividend. Is that dividend safe?
Yeah, so they just announced a very large sale last month. Now their payout ratio is going to be 80%. Down from up close to 100 and going lower in subsequent years. So we think so.
You are watching Market Call. Time now for top picks. And normally I would get exasperated by these picks because they're the large caps. It's Microsoft, Meta are the two of them. But you know what? It's an interesting time to be saying add some more here or dip your toe in, especially Microsoft. So you got a nice pullback that you could capitalize on.
Yeah. You know, so Microsoft reported beginning of the month, and I think it was on the revenues were just a shy, and then they lowered the guidance. It was mainly because of Azure, but if you look at GitHub, it did exceptionally well. So currently trading at 410-ish. We have a 12-month price target of 490. So back at the beginning of the month, earnings rolled over, and then you had all those macro things. It actually pulled back about 12%. So we did a little bit of trimming, and then we're adding down at these, getting back in, because we'd like to get it back into the top 5 of, you know, sort of that 7-8% hold.
So the second pick is Meta, and I think both Microsoft and Meta fit with the earlier theme that you were talking about. There's infrastructure, which is NVIDIA,
yeah.
But now you have to look at who are the builders in this space.
Yeah, who's going to interpret the data within the data centers and the hyperscalers. But interestingly, the two companies that have the most data, you would think it might be Microsoft, but the two companies that have the most data out there are Meta. You know, look at all the social media networks that they have.
And I'm already seeing the rollout in my WhatsApp.
Yeah,
I can have Meta AI, so I've been playing around with it, and it's cool.
Yeah. And then the other one, but we've had it within the last 12 months as a top pick, so we didn't want to pick it again, is Google. And Google is the second one that has a lot of data, and then they brought out Gemini pretty recently, and it's a very, very cool tool to use in there. But anyway, just on Microsoft, the last thing I'll say, I don't know if many of you follow the Rule of 40, but the Rule of 40 basically says if revenue growth rate plus the profit margin should equal or exceed 40%, then it's a good buying opportunity. And then, so right now with Microsoft, their free cash flow margin is about 30. The revenue growth is sitting just shy of 16, so it's sort of between 45 and 46. So on the rule of 40, it's a buy.
Okay, is Meta the same thing?
Actually, Meta is interesting because, oh, we're already on to that. The Meta, yes, because it's trading right now. You know, Meta stock has shown about 50% year-to-date growth, but it's still trading at a 22 times forward PE and a 19 times forward PE on 2026. So it's fair value, right? Because you could easily get those multiples up into sort of the mid 20 level. But then again, you know, Meta is doing a lot of work within the likes of the model training, especially with their Facebook AI research. You don't hear a heck of a lot about it, but they are considered one of the big progressors in the Valley and certainly in Israel on improving that model training.
Let's talk about the third pick, CyberArk. Less of a Mag 7. You kind of hinted actually during the show that this was a name that you preferred, and lo and behold, it's a top pick, Israel-based.
Yep.
What do you like here?
So they really are the leader, and even Gartner, the big research firm, says this, that they are the leader in that privileged access management segment of security. It's called PAM. And that's where a lot of the security breaches actually happen, either internally or with customers. And so there are 4 main businesses on that PAM is identity security, workforce identity, customer identity, and then secrets management. It's currently trading right around sort of 280. Now, the runway on it, and a lot of people like it because the runway is only up to 320, so there's only $40, so that's what, about 15–16%. But I'd buy it here and add to it down, and these are the levels that we have, add to it down at sort of the 265 and then maybe down at 255, and it shouldn't go under 250.
Talk to me about valuations, how I should think about it. No PE really because it's losing money, although it's forecasted to be profitable. These are just Bloomberg estimates.
Yep.
You gave me some dollars per share numbers, but help me understand valuation. In 30 seconds.
Yeah, it's not cheap.
Okay.
But a lot of people took their money out of CrowdStrike and tried to find other places. And so they went to Palo Alto, Sentinel-1, and they also went to CyberArk. The other thing I'd say about it, remember, Google was going to buy Wiz.
Yep.
This is another Wiz.
Okay.
And it's in Israel. It's just the same as Wiz.
Time out for top picks with Andrew Pyle of CIBC Wood Gundy. Your first one is an ETF. It's a cybersecurity and technology index ETF. Holdings include Sentinel-1 is actually the top holding there. What do you like about this ETF and the space?
Well, two things, Amber. So first of all, as we look at AI's prevalence in the economy growing over time, which we believe it will, there's a lot of positive benefits that come from that. There's also a lot of negative repercussions as well. So the increased demand for cybersecurity, I think, will remain, which is why we start to move money into this particular ETF, aptly named XHAC, as you can see on the screen. It's a diversified way of playing the space, right? And a lot of people will say, well, what about CrowdStrike? We've heard negative stories about that. CrowdStrike is actually not in the top holdings of this particular ETF.
I was just going to say that. Yeah, amazing.
Yeah, it's not at the top. And in fact, what you will find in the top holdings of this particular ETF, Amber, are actually a lot of companies directly in the AI space, right? So it's also, a way to play the AI in a different format than just going after, say, an NVIDIA or a Microsoft. It's actually a way to actually get some exposure to that. But the main reason why we're in is because we think demand for cybersecurity is only going to increase over time.
Even has a BlackBerry in there. It's an itty-bitty position, but it is in there.
Exactly.
Your second one is McDonald's, which is interesting. Well, for two reasons. You're choosing the McDonald's that trades on the TSX, a Canadian depository receipt. First, tell me why this approach for the Canadian investor, and then why McDonald's in general.
Yeah, good question, Amber. So when we start looking at building out the large cap U.S. names in our portfolio, again, typically you would buy them in New York, buy them in U.S. dollars. Our view really on the Canadian dollar is that we're trading very close to what I believe is going to be the low part of a historical range. I think the Canadian dollar over the next 5 years probably starts to improve back up towards 80 cents. What does that mean? Well, that means that if we're going to buy these stocks in New York in U.S. dollars, we're going to inject currency risk into that. If these companies do as we hope, and they go up in value over the medium term, and the Canadian dollar also goes up, we'll use the same percentage, then that really negates our return on that. So we're using CDRs right now to get exposure to large cap US names and trying to get rid of that currency risk, because these stocks, these CDRs, are hedged back to Canadian dollars on a daily basis. So it really effectively reduces that currency risk close to zero.
And in McDonald's, on McDonald's in particular, why do you like it?
Yeah, it's a name that we put in the portfolio back earlier in the summer. I think you and I talked about this on the show, Amber. It really was a value play. We thought McDonald's stock had really been beaten up beyond where it should have been. The fundamental value and the intrinsic value of this company was well north of what the stock was trading for. So we did put it in place, had a nice, initial rebound. And, the stock has faltered recently, and we had one of our callers talk about that today. We still like the name. We like the valuations on this company. And then for us, this is a leader in its group. We can play it off against QSR, but at the end of the day, I think McDonald's fundamental story going forward is strong. And it's going to be one of those probably more recession-proof stocks to look at. Again, not that we think we're going into one, but we do like these valuations. We
touched on this in the show, but Microsoft, the similar strategy, the CDRs is how you're playing it. The dip is getting smaller, from where it has sold off from the peak, but it seems like you're buying that dip here.
Oh, exactly. So one of the callers, had it right. We look for names when there's blood in the water is typically when you start to go fishing. And think back 4 weeks ago when, the bottom came out of this group and people were abandoning the thesis when really this was a short-term aberration, linked somewhat to the carry trade or, thoughts about recession. But we're buying Microsoft, because it's a solid company. I think now it's one of the only $2-3 trillion plus companies after NVIDIA's performance, all that'll probably come back. And we like, its AI product line right now. So yeah, we continue to pick away at weakness on Microsoft. We are using the CDR exchange for that, for the same reason. If we're going to get decent growth on this stock, we do not want it negated by any movement in the Canadian dollar going higher.
Time now for top picks, the punctuation in market call. We've had Mike Philbrick with us for the last hour. Now he's going to share his best ideas going forward. The first one, I mentioned gold's at a record high, and you want to stick with that trade. iShares Gold Bullion ETF. What do you like about this, and do you prefer it over the miners?
Although I do think the miners are another way to play exposure in gold and may have some leverage to the actual price of gold as we go forward. And again, Amber, I'll emphasize, it's not or, it's and. So you don't have to have bullion or stocks. I think you could have both. But gold remains extremely attractive in today's uncertain economic environment. You've had ebbs and flows of inflation. That's not going to go away, both on the upside and downside, potential for rate cuts, the geopolitical tensions. Recall, if you will, earlier in the year, we had gold moving from the west to the east. Shanghai gold was trading at a higher price than London gold, and it was being bought in London and shipped to China. And that was a bit of a result of the confiscation of Russian assets and in the invasion of Ukraine. And gold is a funny asset in that gold is not anybody else's liability. And so when you see central banks continuing to increase their reserves while we're hitting all-time highs, the interesting thing that's changed in the interim is during the middle of the year, flows to exchange-traded products in the bullion space were actually outflows, even though the price was strong. Now that's since reversed, and so the retail and institutional crowd has caught on and started to allocate more to gold, while at the same time central banks are. That sets us up for some, I think, pretty decent upside for gold. And again, it's a very unique asset. It is not anybody else's liability. And so it is a particularly unique asset to add to a portfolio and very complementary to stocks and bonds.
I don't want to spend too much time, but in 20 seconds, does it matter? The U.S. dollar has been falling. I imagine that helps bullion. Is there a risk
Absolutely.
If the dollar starts to rise?
There is, but there has been lots of incidences in the past where both the U.S. dollar and gold have risen simultaneously. So it's not just the dollar going down that boosts the price of gold. Okay,
let's bring in, we've been dancing around this one, small caps. Your preferred way to play it. And by the way, the bullion one was ticker CGL.C for our listeners. The small cap one that you're playing is the TD U.S. small mid cap ETF. TQSM.
Right. And so this gets us both small and mid cap stocks. So we're getting into we're a little bit more diversity, a little bit bigger a group of stocks to choose from. And TD uses a rules-based system to identify, some better companies in the small and mid cap space. So you're looking at historically low valuations relative to large caps, which presents a pretty compelling opportunity. You've got a very interesting interest rate backdrop. You've got, some of that more sensitive to interest rates and economic changes that would be opportune for small caps. And then what you're doing with the TD fund is it's that quantitative based type of strategy, which is looking for higher quality companies that have good balance sheets and actually have some price momentum. So that's a great way to outsource the expertise for a very small increase in the fee and get exposure to both small and mid cap. And here I would not hedge the currency. Again, I'll just repeat 2000 to 2005. Last time we had that large cap dominated market, large caps produce a negative 11% rate of return, while U.S. small caps delivered plus 42%. When that rotation happens, you want to be building some exposure into this asset class, this slightly different market capitalization portion of the U.S. market into your portfolio. Start to build the positions early, and so you can participate in those returns.
Okay, in the last 2 minutes, let's get to this one, a little bit more complicated. It's a managed futures strategy. The ticker is DBMF. What is it, and why does it outperform?
Well, this one it trades in the US as well, I'll add. So that's a US ticker. But managed futures strategies are quite dynamic, and they include assets beyond traditional equities and fixed income, in that they include currencies and commodities. They use systematic rules-based approaches often, and they can go long or short the market. And now, when that happens, they become a very good diversifier for a traditional stock and bond portfolio. If we look back at 2022, when we had stocks and bonds go down simultaneously together, had about a 20% correction in markets, this particular product was actually up 20%. So these types of strategies, managed futures strategies, often have very low correlation with those traditional asset classes that we know, love, and trust. And so they can be real enhancers if we get into a bear market, if we get into higher stress, heightened volatility. If you have this in your portfolio, you can prepare today, right? In 2022, if you had in your portfolio, while your portfolio was down 22%, this diversifier was up 22%. That gave you the opportunity to rebalance and to have something to sell and buy low, if you will. So those managed futures strategies often act as very good diversifiers in difficult market times. And so that's why I think if you're thinking ahead, you might start allocating to something like this now, so that you don't have to worry about when it happens. Oh, do I sell now? What do I do? You've already got a diversifier in the portfolio helping you attune to that.